The leftover three topics in balance sheet management is liquidity risk, interest rate risk management and RAROC. Let us take up for discussion today liquidity risk management. What I am going to cover is in liquidity risk management, definition of liquidity, dimension and role of liquidity risk management, measurement and managing liquidity risk, measurement of liquidity risk through ratio analysis. And this again will have this measurement will be divided into a stock approach and a cash flow approach that we will see. What is the objective of liquidity management? Number one, ensuring profitability, that is a long term goal, and the short term goal is ensuring liquidity. So whenever any fund outflow takes place, it should be managed through liquidity. If we anticipate that liquidity, then we keep the money set aside for this. If you don't anticipate this cash outflow, then you will have to wind up or sell all the jewels, all the long term assets of the bank at a loss, so it will affect the profitability. That is why any liquidity management, it is twofold. One is ensuring profitability in the long term and ensuring liquidity in the short term. The numerous bank failures and couple of liquidity crises at major banks during 80s and 90s have made bankers in the developed countries, including US, more and more aware of the need for liquidity. So balance sheet may be very sound, all your assets are long term, but the bank is not having short term liquidity to pay for. So because of the reason, a bank may go into liquidation. This is what the scenario is in 1980s and 1990s. That's why the liquidity has gained so much of importance. Banks need liquidity to meet deposit withdrawals and fund flow and fund loan demands. One of the peculiar feature of Indian deposits, the facility which banks are giving to them is, even though it's a 5-year deposit, there is no guarantee that this deposit will run for 5 years. So a depositor invested the money for 5 years. After 3 or 4 months, he can come and ask for premature closure of the deposit, and it creates an unanticipated withdrawal for the bank, and for that they have to provide liquidity. Liquidity represent the ability to accommodate decrease in liability, that is withdrawal of deposit, and fund increase in assets, that is when the bank is dispersing the loan, the asset goes up. That's why any liquidity, when the liabilities are coming down, then the cash outflow, when the assets are increasing, there's a cash inflow. Liability is essential for all banks to compensate for expected and unexpected balance sheet fluctuations and provide funds for growth. So expected comes when there is an agreement that when the bank is releasing the loan on such and such a date, it is an expected outflow, the borrower comes, the funds are released. But whereas unexpected outflow comes because of your foreclosure or premature foreclosure of term deposits, or expected cash flows, outflows comes for deposit when the deposit is withdrawing the money on the due date or on the maturity date. What are the dimensions and role of liquidity risk management? Let us see. Liquidity risk is the inability of a bank to meet such obligations as they become due without adversely affecting bank's financial condition. It means any cash outflow, the liquidity, it has to be met with little hassles, and the liquidity is the inability of the bank to meet. So when we don't keep so much of provision, then it creates an inability on the part of the bank. Effective liquidity risk management helps ensure bank's ability to meet its obligation as they fall due and reduces the profitability of an adverse situation developing. That's what I already told. If you expect an outflow and you keep provision for that, then you are able to wind up all your assets at a profitable situation. If that outflow takes place suddenly, then you will have to liquidate all the assets at a distress sale, that the profit otherwise which the bank will get reduced because of the distress sale. Liquidity risk assumes much significance on account of the fact that liquidity crisis, even at a single institution, can have systemic implications. It means we have already seen that as and when this liberalization process is going on, all markets are interconnected and all the banks and financials work in this market only. So when one bank fails, the failure it is passed on to the other, it affects the functioning of the other bank. So a one bank failure may lead to failure of successive or a cluster of banks in the system. That's why it's called a systemic risk. It has got a ripple effect. Effective liquidity management by banks serves 4 important functions. What are the 4 main important functions of liquidity management? 1. It demonstrates in the marketplace that bank is safe and hence capable of repaying its borrowings. When a bank is managing its liquidity risk effectively, it creates among the public that this bank is a safe bank. Number 2, it enables a bank to meet its prior loan commitments. So when the loan sanctions are given and the bank says that you come next Monday or Tuesday and draw the money, the borrowers are also having a confidence, they come on such and such a date and they take with the prior commitments. 3. It enables the bank to avoid distressed sale of assets and make the bank to go for planned sale of assets, which fetches reasonable price for the bank, and by this loss can be avoided. This point I have already explained. It lowers the default risk premium the bank pays for funds. So when the bank is managing the liquidity risk very well, so whenever they want to raise borrowings from the market, naturally the interest rate that they are paying will be less. But very frequently, if the bank is exposed to liquidity risk, they are not able to manage, automatically the lenders increase the rate of interest at which they are going to lend to that bank which has already defaulted. So it lowers the default risk premium the bank pays for funds. For banks in distress, the interest rate quoted for funds would be very, very high. Bank's liquidity position depends on the following 8 factors. What are the 8 factors that affect the liquidity position? 1. Historic funding requirements. This is based on the discipline of the bank. If the bank is brought on a very well defined discipline line, they always forecast all the cash flow, they keep sufficient liquidity, and they will not have any history of default. So when they don't have the history of default, their rating in the market goes up. So historic funding requirement. Current liquidity position. Suddenly the system itself is surplus with funds, system itself is shortage of funds. When shortage of funds are there can be more cash outflows. So the liquidity position is to be, the system is to be seen. Anticipated future funding needs, sources of funds, what are my sources of funds available, options for reducing the funding needs, present and anticipated asset quality. When asset quality is good, the liquidation chance or the convertible chance into cash is very high. If this asset quality is very bad, once it becomes NPA, the bank loses not only the earnings, the cash inflow also. Present and future earning capacity, again this comes from the point number 6. If an account becomes NPA, the bank is losing the earning capacity on that asset. That's why from performing stage it goes to non-performing. Present and future capital position. If they have got a surplus capital more than required, that capital can be released for meeting the liquidity outflows. So again, if I got a good car, good capital more than required, that can also be used. Some of the factors which affect bank's liquidity would include, what are the factors that affects the liquidity risk of a bank? A decline in earnings. Cash inflow arising out of profits gets affected. This point we already covered. Higher the NPA, the earnings comes down. When the earnings comes down, the cash inflow comes down. An increase in NPA, cash in, again it is an offshoot of point number 1. Cash inflow from asset gets affected. Deposit concentration. If the bank goes for wholesale deposit, bulk deposit, big deposits, then people, all these bulk depositors, they look only for interest rate. They will not have loyalty to the bank. So which bank is offering higher rate of interest, this deposit will get pulled out of this bank. That's why deposit concentration, if it is on a retail, if the deposits are from retailers, then the cash outflows are less because most of the deposit will liquidate the deposit only on maturity date. Downgrading by rating agencies. Any downgrading takes place, then the market loses faith on the bank, then there can be a sudden cash outflow, there can be a run on the bank. Expanded business opportunities. Since banks is expanding business, cash outflow can come from new businesses. Any new business requires capital and cash outflow. Again, acquisitions. When bank goes for acquisition, joint venture, again there are cash outflows. change in tax structure. In case the tax slab goes up, naturally it results in outflow for the banks. We have seen the functions of liquidity management. We have also seen what are the factors that affect the liquidity. To create liquidity for meeting the funding needs, a bank has to perform one or more of or a combination of the following. It means I want to create a liquidity. There are 5 situations. You can go for one or combination of either 1 or 2 or 1, 5, 5 or all the 5. So that combination can also be tried. Dispose of the liquid assets. It creates a cash inflow. I got money invested in 91 days. A bank has invested 91 days treasury bill. It's a liquid asset. Anytime you can exit, you get a money. Increase in short-term borrowings. Any short-term borrowings, call money lending, call money borrowing, if the bank goes, then it creates a cash inflow. Decrease holdings in less liquid assets. Illiquid assets you avoid, and again go back to point number one, instead of investing in illiquid assets, invest in liquid assets, so the chances whenever the bank wants cash, they can liquidate this. Increase liabilities, particularly term deposits, because if you concentrate more on current account and savings, they are all callable, it can be withdrawal on demand, whereas term deposit is a maturity period. So particularly from retail deposits, the retail depositor they withdraw only on the maturity date. That's why increased liabilities, particularly term deposit. And infusion of capital, yes, that is also there's a cash inflow. Any infusion of capital, there's a cash inflow, then that cash inflow can be made to meet the liquidity outflows. Now liquidity risk has again got subcomponents. They are divided into funding risk, time risk and call risk. Now let us see what is funding risk. The first subcomponent of liquidity risk. Funding requirement met from markets due to unanticipated deposit withdrawals, non-renewal of deposits. Some of the examples are premature closure of term deposits, which I have discussed already, and loss of confidence on the bank. If the bank is not meeting the liquidity in time, it creates a run on the bank, the deposit loses confidence on the bank, so many people come and withdraw money. So this is called funding risk. Then let us see what is time risk. Time risk arises out of non-inflow from borrowers, particularly compensating the funds from the market due to non-receipt of expected inflow of funds. Some of the examples for this type of risk is performing asset turning into NPA. In performing asset, the bank gets monthly or quarterly EMI. The moment it becomes NPA, the borrower stops paying the servicing the loan, so that the bank will not get any inflow. One more example is that performing asset turning into NPA due to macroeconomic fundamental. Now my borrower is good, but because of the macroeconomic fundamentals, the exporter has taken pre-shipment credit, packing credit, he has done, he has packed the goods, he has kept it ready, and in fact before he could ship the goods, the order gets cancelled. So this is beyond his control, so the account becomes NPA, not because of his performance, because of the macroeconomic fundamentals. Then let us move on to the third risk under funding, under liquidity risk. It's called call risk. This arises out of non-fund based facilities. We have already seen what is non-fund based facility. Non-fund based facilities are letter of credit, bank guarantees, because they don't create any cash outflow the day on which bank signs a letter of credit or bank guarantee. It creates a cash outflow only when my borrower is not meeting his commitment on the due date. So conversion of non-fund based limit into fund based limit, as told already. Importer not meeting his commitment on due date, contractor not performing the contract as per the terms and conditions, and beneficiary of the letter of guarantee invoking the guarantee. All these things, when the customer is not meeting the cash outflow, then the outflow takes place on the bank. Now let us see how to manage the liquidity risk. The analysis of liquidity risk requires bank management to measure not only the liquidity position of banks on an ongoing basis, but also examine how the funding requirements are likely to evolve under crisis scenario. Yes, under normal scenario, the cash outflow is less, whereas under crisis, the cash outflow will be more. So when a crisis arises, how the bank is going to meet the liquidity risk, because any liquidity risk includes how the bank is going to meet it under normal condition, complex condition, most complex condition, that's all called as crisis scenarios. Following steps have to be taken for managing the liquidity risk. What are the steps? Develop a structure for managing liquidity risk. You must have a structure, a bank should have a structure. Set tolerance levels and limit for liquidity risk. Don't expect that liquidity risk will not arise. Yes, definitely it will arise, and if it arises, how much money I should give. So this tolerance or limit is to be decided, measuring and managing the liquidity risk. Now let us dwell on these three subjects individually. Developing a structure for managing liquidity risk. How the structure is to be developed? Sound liquidity risk management involves setting a strategy for the bank, ensuring effective board and senior management oversight. The bank should not think that the liquidity management is managed only by treasury or by the branches. So in managing, what are the strategy, even the top management, the board should be aware, because they can also advise the bank in a better manner. So their oversight is a must. Sound liquidity risk management involves setting a strategy for the bank, ensuring effective board and senior management oversight, as well as operating under sound process of measuring, monitoring and controlling the liquidity risk. This should be done, your measuring, monitoring and controlling should be done on an ongoing basis. While evolving the strategy for liquidity risk, some of the factors to be considered. Why? Yes, strategy is to be formed. What are the factors that will be taken into account? Let us see that. The responsibility of managing the overall liquidity of the bank should be given to a specific identified group. There should be a specific task, a responsibility should be given to a department. Then only it can be done. This can be in the form of asset liability management committee, or also called as ALCO. The strategy arrived at should be communicated to all the departments and staff who conduct activities having impact on liquidity. Yes, the responsibility of managing the liquidity goes to ALCO, but every staff who is involved in this cash inflow and outflow business, they should know that one authority is working, one department is working, whose main function is to manage the liquidity of the bank. So every staff should be aware that ALCO is functioning. So any cash inflow, cash outflow, they can inform this ALCO so that they can gear up themselves when the outflow takes place. There should be provision for the board to monitor periodically how effectively the bank is tackling the liquidity risk. Yes, the board, the ALCO should put up at least on a monthly basis or once in a fortnight how they have managed last 15 days, how was the cash inflow and outflow, and if surplus is there, how they utilize the surplus funds. If there was shortfall, they should see how they manage, how they overcome the situation, so that when it is put up to the board in its wisdom, they can also guide the ALCO in a better manner. To continue developing a structure, what are other factors? For banks with international presence, if I am a bank only involved in domestic, my only worry is rupee inflows and rupee outflows. But when the bank has got cross-border business, then their outflows and inflows can be foreign currencies, mainly dollar. Let us take banks like Citibank, Standard Chartered Bank, who are functioning in India. They have got multi-currency balance sheet. They not only deal in rupee, they deal in other currencies also. If it's a Standard Chartered Bank, their main currency dealing may be pound sterling because they are registered in UK. If the Citibank, their main cash inflow outflow internationally can be dollar because they are registered in USA. So for banks with international presence such as Citibank, Standard Chartered Bank, the treatment of asset and liabilities in multiple currencies adds a layer of complexity. It means these banks have got additional responsibility. Besides managing rupee in India, they have to manage their foreign currency sources also. So it adds a layer of complexity to liquidity management, as these banks, besides managing liquidity in domestic currency, should also manage the liquidity in the foreign currency in which they are dealing. The banks which are conducting its business in multiple currencies can follow any one of the three strategies given below. One strategy is that all the currency management, let us think, you take the case of Citibank, New York, let us think it is head office. It can control the entire liquidity risk from New York, including their operation rupee, it means rupee inflows and outflows. Let us think that the operation Hong Kong dollar inflow and outflow, and internationally dollar. It means everything is controlled from head office. This is one approach. The second approach is they can also decentralize. In case of Citibank, Let us think that Citibank Mumbai will take care of rupee, Citibank Hong Kong will take care of Hong Kong dollar, Citibank London will take care of pound sterling. Like that it can be decentralized. Such a setup is also possible. There is a third setup. That setup is that the third approach can be Citibank can create important centers. Say they can have New York, London and Hong Kong, and let us think that Hong Kong, it will take care of the Asian requirements in all the currencies including dollar, Hong Kong dollar, Aussie dollar or rupee, and London will take care of all the currency requirements. So the number one goes with the control lies with head office, then number two it is decentralized control, and number three they create hubs in important centers and they act as head office for that branch or for that area alone.